So I had another video planned for today, but I just had to make this video for you guys because it's been something that I've seen pop up time and time again. And really, this is something that needs to be discussed, especially for brand new investors. You work so hard for your money, you then think of different ways that you can invest this money to make more money. So things like individual stocks come up, maybe ETFs, maybe even mutual funds. And of course you go in, you kind of look through the list and you're like, okay, you know what, this one looks pretty good. I'm gonna go with that one. So now if this sounds like you and if this is what you've done with your investments, you definitely want to stick around because you may be paying huge amounts of money here just in management fees. A couple hours of your time today could actually be saving you a couple $100,000 down the road when you do plan to retire. So in this video, I'm going to show you exactly how you can optimize your investments so that you're not paying hundreds of thousands of dollars in fees and instead keeping that money in your pocket. So like I said, when someone gets started with investing, the first mistake that they usually make is that they go in and they see the ETFs, they maybe look at some graphs, look at the past performance, like, wow, this ETF has performed incredibly well in the last 5-10 years. I'm gonna just put my money into this and it's gonna continue doing this in the next 10-20 years and I'll be happy. So to the people who did that, and if this sounds like you, the question I wanna ask you is, if you are serious about saving your money and investing your money, why would you go with the easiest route possible and not spend time to actually research this and make an informed decision? Now, don't even get me started here on Robo Advisors. I'm going to save that for another video. But if you're going to take the time and open up a self-directed investing account, it makes sense in my opinion to spend just a little bit of time to figure out your options, figure out your best option, and then from then on, you don't really have to worry about the account at all. But that initial time investment is what I see a lot of investors not make when they start investing in the stock market. Instead, unfortunately, what I see is a lot of new investors, when they want to put their money into the stock market, start working for them, they'll go to a financial advisor or they'll just go to one of their friends and kind of get advice that way. And this can really go one of two ways, right? So the first is that if you go to a financial advisor, more often than not, they're going to advise that you go invest in a mutual fund. And of course, if you invest in a mutual fund, you're going to be paying massive fees, typically between 1% and 2%. And if that doesn't sound like a lot to you, just stick around because I'm going to show you exactly how much that's going to cost you over the next, say, 20-30 years or so. The second option people do, like I said, is they go to a friend and then their friend is like, you know what, you should buy this stock, this stock, this stock, this stock because look how much money I've made on it and I think it's going to keep going up, so you should buy into that right now. Sometimes these stocks end up being good, sometimes these stocks end up being penny stocks, but either way, that's not an investment strategy. What happens if that company goes bankrupt? What happens if that stock crashes tomorrow? Are you going to go to your friend and say, well, you're the one who told me to do this, so it's your fault? Well, maybe that friend says, okay, yeah, it is my fault, but in the end, who really suffers? It's you. In my opinion, both of these options should be avoided by any new investor, even any existing investor really, because there are better alternatives out there now. You have mediums like YouTube where you can actually go and learn things on your own if you just take the time to do that. But either way, after these mistakes are made, maybe you invest in a few penny stocks, maybe you're in some mutual funds, maybe eventually you decide, okay, I'm just going to go and invest in these new things called ETFs and just kind of leave my money in there, and I've heard ETFs are the best, so I'm just going to, pick an ETF and just hope that it does well over time. Well, this actually is a good thing now that you've actually come to ETFs instead of mutual funds or individual stocks for a brand new investor. But even with ETFs, there are a few things you need to consider before putting your money into them. Now, if you're sick of losing your hard-earned money like I talked about, the one thing you need to pay close attention to is the management fee, or the MER. So what I thought we'd do is actually go through a working example here, and we're going to jump over to my screen and I'm going to show you just how much the MER can affect your investment. So let's just say we start off here with the hypothetical $10,000 investment, and every single year we put in about $10,000 as well. Now, say we're in our late 20s and we have about 30 years for this account to grow until retirement. And on average, the S&P 500 returns around 7% after inflation. So now we compound this once and every single year, and this will give us around $1.086 million in 30 years. Okay, so this is our reference value. Let's keep that in mind. Now let's hop over to this calculator here, and pretty much what this does is it actually lets us calculate how much money we're going to be paying in management fees. So let's just enter the same amount of information here, $10,000, yearly contribution $10,000, average rate of return 7%. Now let's just say our management fee, if we went with the VOO, which is my favorite S&P 500 ETF, has a management fee of around 0.03%, investment term 30 years. Now if I click calculate, scroll down here, you'll see that over the span of 30 years, I've paid around $3,000 in management fees, and that measures up to around $5,700 in lost earnings because of compounding that's being lost. So essentially, I've lost around $5,700 worth in those 30 years because I invested in the VOO with a 0.03 management fee. Now, here's where things get crazy. Now, let's go to Fund B and input the exact same information here. $10,000, 7%, 30 years. But the only difference will be that we pick a higher MER. Now, on average, most mutual funds range between 1 and 2.5%. So I thought it'd be fair to pick around a 1.5% management fee. And let's go down here, click calculate. And I hope you're sitting down for this because you can see that the difference is incredibly huge. You're spending around $152,000 over 30 years in management fees with a 1.5% fee. Now that equates to around $336,000 that is lost in investments because you're not able to compound this amount of money. Now you tell me which of these two options looks better. Does it make more sense to spend $3,000 or $152,000? Does it make more sense to lose out on $5,700 or $336,000? I think the answer here is pretty clear, and it makes sense to me that the option on the left here, VOO, is typically the best option for S&P 500 index investing. Now, say you're on the higher end here of the management fees and you're paying 2.5%. I've seen that in some people's accounts. It's actually incredibly insane how much these banks and these funds charge you. But say that's the case, everything else remains the same. Calculate. This is just mind-blowing. You've now spent $253,000 in management fees, which equates to around $628,000 lost over your investment career. So remember, out of the $1 million that we're expecting to earn, that's how much is paid out directly to your management fees, and that's how much we're missing out on over the growth over the 30 years. So clearly you can see that the MER or management fee is a critical thing to look at and consider before investing your money into an ETF. A set and forget strategy does work best for most investors. You don't try to time the market, you try to put money into that account every single year and just let that compound over time. That typically works for investors, but you still want to put your money in the best investment vehicle to get you to that stage in retirement. You don't want to be ready to retire and have your account worth significantly less, typically a couple $100,000 less, just because you paid higher management fees for the exact same product. Now, when I say product, I mean, like, for example, the S&P 500, many different options to invest in the S&P 500, but if you pick the wrong one, it could cost you. So now I want to ask this question again. If you work hard for your money and you're actually serious about investing that money and growing that money, does it make sense right now to spend just a bit of time, maybe, a few hours here and there for the next few weeks to learn about your different investment options, which could potentially set you up for much greater success when you are ready to retire? Literally, a couple of hours spent today can save you a couple $100,000 in the future. So the question you got to ask yourself is say 2 to 3 hours of your time worth saving $200 to $300 in the long run? Guys, I think for brand new investors, ETFs are the way to go. You want to keep those management fees as low as possible to keep the money in your pocket and not the investment banker's pocket. If you appreciate this video and you see my passion for this topic in this video, drop a huge like. That's the best way you can thank me for making something like this. And let me know in the comment section down below if you want to see similar videos like this or videos on a different topic which you think that yourself or maybe others will find valuable. Thank you so much for watching, guys. Don't forget to invest positively. I'll see you in the next one. Peace.